Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
For the next good amount of time, Bob Michele will join us. You know him from the Fed Decides, driving all of JPMorgan fixed income, huge advice he has to give to Mr. Diamond and the senior management. I'd go back to Maynard Keynes at Bretton Woods, but why not? Let's go back to the guy that really said it, Paul Samuelson, his iconic textbook of 1948. When the facts change, I change. What do you do, sir? For Bob Michele and JPMorgan, have the facts changed?
Well, first, Tom, thank you for reminding Jess. Forget about this equity stuff. Bonds are at the top of the capital structure.
This is really important, folks. Bob and I are going to talk about this. The way you learn that bonds matter when you're a mouthy equity guy like me is you lose money and realize you wouldn't have lost it if you paid attention to bonds. Continue.
We welcome everyone who wants to conserve capital.
Very good. Where are we right now? Have the facts changed, Mr. Michele?
I'm going to up you one on Maynard Keynes and go with Rogoff Reinhardt. I wonder what they're thinking after spending years writing a series of papers on financial repression and warning governments about the problems with excessive borrowing and debt to GDP climbing. It has all changed. What we knew as core Europe and fiscal austerity is gone. They've looked at the US and China. They want to join the party, and they're coming in and doing it. So yes, everything has changed.
2 days after this, I had the honor of David Folkerts-Landau of Deutsche Bank, who you and I know has worked with Peter Garber and all, and he was heated that Europe would shift to fiscal liquidity. So I guess that's happening now within all the research capabilities of your bond platform and your economics platform. Is there a confidence Europe can make the shift with or without NATO?
We would argue they have to. If you look back over the last couple decades, Europe has underinvested in itself.
Yep.
And that's a result of decades of fiscal austerity. And they realize, certainly in Germany, that they have to catch up. They have to invest in their military. They have to invest in fiber optic. They have to invest in roads, bridges, all that kind of stuff. And they're going to, and they have the fiscal capacity to do it.
So when we're looking at the 10-year Treasury peaking at around actually 4.8 in the middle of January to where it is now around 4.2, what do you think the bond market is telling us in the U.S. and the economy?
The bond market is telling us we are your safe harbor. We are the anchor in the storm. We have yield now. So when there's volatility in policy, when there's volatility in risk assets, come in and join us. We will protect you.
So what is the best way when you're talking to your clients to position at this point?
I'm having meetings with clients every single day. I had a meeting yesterday with the University Endowment thinking about these issues, and we met with them 5 years ago. 5 years ago, the aggregate bond market was yielding 2.25%. Today, it's yielding 4.5%. They didn't invest then. They're coming in now. They're making smart decisions. Investors want to get into a bond market with yield. You're starting at 4.5%. You can construct a portfolio of over 5%. That's very different than zero and negative interest rate policy.
I look at the yield space, and the answer is we've got a Bob Michele vector. You have called for price up, yield down. Maybe this is not the reasons that you looked for, but can you get this price up, yield down with tangible economic growth to sustain the machine? Dovetail this with Michael Feroli's work. Are we heading towards some form of NBER recession where we don't get the growth? Or are you more optimistic that we can get the Michele yield plus some potential GDP growth?
Yeah, I think the Fed has done a really good job of taking us into a soft landing. I think they're going to pull it off. I think we're going to get yields to stabilize here. Maybe the front end come down a little bit. The Fed still feels uncomfortable that they're too far away from their neutral rate. I think there are a couple more cuts coming, but I'd like yields to just stabilize in here. I don't actually want the 10-year to trade too far below the mid-4s. I wish it would just stay there.
Right.
I wish the 2-year would stay about 4% and give investors the opportunity to get into this bond market.
You and I know, with the Pope so ill, there's the Vatican, and we hope for his healthy recovery. Bob Michael, for you and me, the Vatican's on Madison Avenue at the JPMorgan Library, and you go in that red velour room where he locked the door and said, we have to save the country. We didn't have a Fed in the Gilded Age. Doug Irwin's in the FT, I believe it is today, with a brilliant interview of Dartmouth saying, look, it is the 19th century. Abby Joseph Cohen said yesterday, it is the 19th century. How does this Fed help the nation given tariffs?
The Fed has to balance all of these things. And I think a month ago, everyone and the market looked at tariffs as an impulse to higher inflation. Today, they're looking at it as a drag on growth, the material one. I tend to look at tariffs as economy killers. So yeah, you get a price shock higher, but that's going to dial down aggregate final demand. And that's what I think the Fed will be focusing on. They're going to be laser focused on the labor market. They're going to see if businesses and households retrench.
I agree with you on the labor market. Carl Weinberg on yesterday, High Frequency Economics. Olive Zirkut Lehman is at a 4.8% unemployment rate in the vicinity of Labor Day. We welcome all of you on your commute across the nation on YouTube worldwide. Good evening in India. I've got a special focus off of Ray YouTube on what you're doing in Bangalore and in Mumbai. We say good morning. Internationally on YouTube, subscribe out at YouTube to Bloomberg Podcast, growing each and every day. Jess?
Well, Bob, this is, as you know, the last week we're going to hear Fed speakers before they go into that blackout period before the decision in the middle of this month. And of course, we will hear from Fed Chair Jerome Powell on Friday when he gives a keynote speech at the Chicago Boost 2025 U.S. Monetary Forum. So what do you think markets want to hear from Fed officials before this week wraps up versus in reality what we will end up hearing from them?
I think what we want to hear is how they're weighing tariffs. And are they still looking for an opportunity to bring rates down to what they believe is a neutral rate? We'll also get the infamous dot plot, so we'll have some idea of how much higher the long-term neutral Fed funds rate will have crept up. I think it goes up about 0.25%. I'd expect Jay Powell to be very, very balanced and basically try to take a pass.
It's almost medical, first do no harm. Tell me about the dynamics of the market. I noticed like 3 months, 7-year went inverted the other day. Nothing I ever look at. But how does, when you go in, Bob, and Bob has 3 Bloombergs with 12 screens, unbelievable. The glow in the new JPMorgan building, it shines off Citadel across the street. It's amazing how they're on their binoculars across. What's Bob Michael doing today? They're looking at him. On your Bloomberg, how do you perceive the vanilla 2-10 spread, the 10-year or the 2-year real yield? What does Bob Michael look at to ascertain this market?
What I'm looking at is yield settling in at levels higher than I believed a year ago they would settle in at. And I like it. I like the fact that we may have a German yield curve from 2% to 3%. Mm-hmm. We may have a U.S. yield curve from 4% to 4.5%, 2s, 10s. I like credit spreads holding where they are because they're pricing in a soft landing. Those are the things I look for, and I think it's a great environment. By the way, we didn't talk about Japan. 10-year Japan, 1.5%.
Amazing. Yeah. Jordan Rochester at Mizuho, you should have hired him. Jordan Rochester says this is a sea change for Japan.
I can't even remember the last time we were up at 1.5%. 30 years ago.
The late Martin Feldstein, who was exquisite on this. Robbie Feldman at Morgan Stanley. That's a different bank, Bob. They said this would never happen, and here we are. With it happening, you're laughing at me, Bob. Bob,
I think we were one before Glass-Steagall, but I'm not sure.
There was a demerger, something. We won't go there, folks. When Mr. Diamond comes in, we'll harass him about it. Bob, I look at this market, and you're advising clients right now. Is it a total return market? The great Dan Fuss at Loomis Sales, is it that kind of market where you can make total return, or are you clipping coupons in the basement?
I think you're going to get some total return with yield settling a bit lower, with the Fed coming in and cutting rates a couple more times this year. But I think it's mostly a carry market. I think it's mostly an opportunity for active managers to do what we used to do pre-financial crisis.
Right.
When sectors get a little bit ahead of themselves, you dial them down
Right.
and go into sectors that lag. I think this is also a bond market for more diversified portfolios to look overseas now. It's safe to go into non-dollar assets.
Jess, this is so charming. There was what we called the Blue Book, which was a Standard & Poor's thick blue book, and the value line you trip over on the floor. And Bob and I would be going, oh, the Boise Cascade, it looks so good today. It's like, remember, this is like, it's like a real bond market.
Yeah, then we didn't know how to price it. There was no
Right.
Bloomberg. We had to punch it into our Monroe bond calculator.
you're
So
killing me.
archaic.
Bill Gross still has this on his. Good morning, Bill, out on the left coast. You had a Monroe trader, and he and Charlie Gogolak were kicking field goals. They tried to make 3 points on a 20-year piece, and a guy named Secunda in Bloomberg showed up, and they said, no, you're not. And overnight, just the museum's right behind us here, folks. Overnight, the Bob Michael Act went away because people could do the convexity and duration. Boom, boom. Oh, God, I can't charge a field goal. Get another question in here, Jess.
Of course, I have to bring up R-star, everyone's favorite topic when people want to debate about the neutral rate, because you were bringing up the dot plots. Obviously, we get those quarterly. We last saw it in December. So when we get those in a couple weeks from the Fed, the longer-term rate that they had updated was at 3. It used to be closer in recent years to 2.5%. Where do you expect when people are debating where the neutral rate actually is?
Remember, they started doing this in 2012 because they had gone to QE, they had brought rates down to zero. They didn't think we in the bond market were smart enough to know what neutral was anymore, so they were going to help us out. That first long-term neutral dot was 4.25%. So that was textbook. That's 2% inflation targeting plus the long-term real yield on the Fed funds rate was 2.25%, 4.25. That's where we are today. I think it's closer to 4 than 3.
20 seconds. Is it stagflation or is it legit dampened but good nominal GDP?
I think it's good nominal GDP. I think we're getting the bad stuff now as far away from the midterms as possible. The good stuff will come at the back end of this year, extension of the Tax Cut and Jobs Act, some deregulation, closer to the midterms, if you will.
I'll editorialize, folks. For those of you in a panic after what we saw at an historic Tuesday, I agree with Mr. Michael. Bob Michael, thank you so much with JPMorgan and the spirit
Always
of the
a
nation
pleasure.
here and on what we see in a constructive nominal GDP, given all the policy out there.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us now, my grammarian, Terrence Haines, joins us with Pangaea Policy. Terry, thank you for the love note yesterday. Mark, the wonderful Mark Crumpton keeps a list of the names I mispronounce, starting with Jess Manton, and it's a long list, Terry. Thank you for adding to it yesterday. So 85% of potassium chloride that Republicans in the Midwest need comes from Canada. You got Feenstra in the 4th Congressional District of Iowa. When does the Republican from Southwest Iowa dial 1-800-TRUMP and say, stop it? When does that happen, Terry?
In the case of Randy Feenstra, I don't think that happens at all, frankly. But the issue here is kind of how to manage the tariff relationship and what the United States gets out of it. Scott Bessent has a great phrase for this, and the essence of it is that it's path dependent. It's path dependent upon what the other side does in tariff negotiations. So I doubt Mr. Feenstra is going to be in a situation where he needs more potash from other sources.
So you're optimistic we're going to get a workout of this, or do we get into the game theory of reciprocity, tit for tat?
Well, I think the answer is both, frankly. You're going to have individual tariff negotiations with Canada and Mexico ongoing based on geopolitical matters. You're going to get the reciprocity overlay on top of it. I think what markets aren't fully digesting is that the end game of this is not more and more tariffs. The end game of this for the Trump people is less and less tariffs. And I don't say that in any sort of Pollyannish manner. But the goal is to actually reduce trade barriers. So
Let me bring in Jess Metton here. Jess, to Terry Haines, please. Don't say potash or potash.
I'll avoid that one,
mic.
Tom. Terry, something I'm thinking about heading into next week, because those implied volatility is picking up steam for the equity market here. So as you know, we still have that deadline for a government shutdown coming on March 14th, but then also on March 12th, even ahead of that, there still is supposed to be those tariffs on all aluminum products. And so what do you think that really means as we're getting closer to those deadlines, as well as other ones that are supposed to happen in the beginning of April?
I think there's still going to be some tariffs on aluminum. They're going to want to show Trump's going to want to show bona fides on that, and I think there's a rising potential for a government shutdown. You see Democrats last night grasping at anything they can to show resistance, to show differences, and the shutdown's it, because what they're about at root is more spending. What Trump's about at root is less spending. There are three parties in the negotiation: Congressional Democrats, Republicans, and Trump. Two of those three benefit politically from a shutdown, frankly, Democrats and Trump. So, there might be one short term. That never matters for markets particularly, but stylistically, it's a bad look.
How do you respond, Terry Haines, to where is John Thune? Well, people say, okay, the House is fractious. Everybody's running for office starting Friday. Great. The Senate is more measured. Where is the senator from the Dakotas?
John Thune, I think, has done a very good job of keeping everybody together, number one, in his party. Number two, he's doing a very good job of quietly establishing the Senate as an effective counter to Trump. You have to look no farther than defense spending to get that. At a time where markets think that defense spending is going down because of some cost savings that Pete Hegseth wants to do, the reality is that there's kind of a dream team of senators that are going to pump up defense spending in no small part to react to China's announcement that it's going to increase by 7+%.
I mean, I looked, Terry, at Ruchir Sharma's book, arguably could be my book of the year. I'm not there yet, folks, on capitalism. And basically, he says, whatever the process, spending will go up. After the speech last night, after what we've witnessed deep into the Trump second term, do you see any frugality out there? I don't observe it.
No, there's no frugality out there. And the reason why is because they judge. I mean, to them, this is not economic policy only. This is not economic crisis or problem only. What this is all about is marshaling and improving the U.S. economy as much as possible, turbocharging it to meet geopolitical goals. Everything starts from debt service. We now pay more in debt service than anything else. That is an intolerable situation if you're interested in United States hegemony, as Trump is. And what they're going to want to do is turbocharge the economy, frankly, to meet those geopolitical needs. That's one reason why you heard so much about manufacturing for defense last night: shipbuilding, steel making, all that.
Oh, that's the politics of the moment. Terry Haines with us, and we're going to continue in a moment. A bit ago, 7:02 a.m., a headline: the United States cuts off intelligence sharing with Ukraine. That from the Financial Times. And now a headline coming out: a Ukrainian official says the nation's still getting U.S. intelligence. We'll see what the next headline says, Jess.
Terry, of course, there's so much focus on those pro-growth expectations potentially from tax cuts and deregulation. What is exactly the timeline of when investors as well as Americans could potentially see some of that happen through Congress?
Well, this is the problem, Jess, is that in a nutshell is that Trump this time out is front-loading the bad news for markets, the tariffs news. with the expectation that things are going to improve throughout the year in markets as they understand that the tax cuts, deregulation, energy dominance, and so on is very likely. That happens. The tax cut bill happens in the fourth quarter of calendar 2025. I'd give it 80% today. 8 years ago, I was almost alone in the markets and telling people that the tax cut bill was going to happen and it was going to be a big one. But the same dynamic exists today. It's going to take them that long to get to the finish line for a variety of procedural reasons.
Terry, I got to get this in from Greg Giroux and Bloomberg Government, and you're expert at this. What are Republicans saying to Mr. Trump, President Trump, who are in close districts? Do they have a say in the discussion, or are they so marginalized nobody cares?
Well, they have a huge say in the discussion, and I'd point immediately to the New York and New Jersey members to whom Trump has owed a House majority on the SALT negotiations, right? So 8 years ago, SALT didn't matter at all. SALT went away. This time out, Trump's listening very closely and positive to those who want the SALT deduction to come back.
Right.
They will fundamentally they'll play the smartest politics they can and try to make sure they do everything to maintain their majorities. Part of that is getting the tax bill done in fourth quarter of 25 so that they can run on it and the benefits in 26. 30
seconds. Is there an El Dorado out there to save the middle ground GOP?
Yeah, there's a bunch of them actually, and I'd put Thune in there among others, but yeah, there's a bunch of them, and there are lots of good pragmatists. French Hill's one, so yeah, I think there's a bunch out there.
Terry, I hope email me every time. I love emails from Terry. Email me, Terry, every time I mispronounce something. It'll be great. Terry Haines Pangaea, thank you so much there on the State of Play.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Someone who's absolutely nailed this bull market, Brian Belsky, joins from BMO right now. Have you adjusted your call?
Wow. No. I mean, as I stand here next to a Red Sox fan.
Excuse me, can we notice, Lisa, how tanned and rested he is? Everybody else in here looks like a pasty puke.
It's all about the deep sleep at night, Tom, and I get that hotel room down to about 60 degrees.
Great. Where are we right now? Have you made an adjustment?
No, we haven't. In fact, we're sticking behind our 6,700 target. And remember, we put our piece out for the year ahead, November 18th. Typically and historically during an election year, we do it right away after the election as soon as possible. And a lot of, quite frankly, strategists that have been late to the game in terms of entering this bull market have much higher targets than us because they published after, and that's okay. Welcome to the party. I'll just pull the great Ricky Bobby and say, if you ain't first, you're last. We've been bullish and resolutely bullish since 2009. It's in record, it's published, and all of that. But I think what's happening is that this is a return to normalcy. Many people don't understand that, but we've had several shots across the bow. I think that momentum investing is changing into fundamental investing. I heard JSE is a friend. I just can't help myself. I just had to do that. Talk about correlations. Correlations short term, are certainly doing that, and that's why the hedge funds are getting crushed, and that's fantastic news as far as I'm concerned, because they're the ones that are causing a lot of the noise, and they don't invest, they trade, and they follow everybody else. So if you're an investor, you want to be more fundamental, more stock picking, and the correlations are actually very low, which means you actually want to be a stock picker.
Right. So those correlations have actually been hovering around their lowest level on record. If you look at the SIBO indicator over the 3-month time frame, so they've spiked up close to where the highest they've been in early September. So coming off of the heels of the yen carry trade unwinding, and also the worst week of the year in 2024. So in relation, still low compared to history, but spiking a bit higher now when things were a little bit more volatile at certain points last year. So that 6,700 price target, that's actually implying a 16% rise for the end of the year based on yesterday's close. So what do you think would need to change in the economy, in the view for corporate earnings, for you to adjust your target in any way?
Well, first off, there's been this rhetoric that earnings have changed. They haven't changed. In fact, earnings have actually continued to improve over the last 2 or 3 months.
And actually, 2026, you still have 14% earnings growth for the S&P 500.
Yes, we do. And I think actually, Jess, that could be too low. And I think why that's too low is you have an increasing amount of companies in the technology space, discretionary space, communication services space that are taking the mantle in terms of leadership away from the Mag 7 in terms of earnings growth. That's number one. Number two, I do believe that earnings and financials are consistently and way understated. And I think we can get a lot of kiss there in terms of the upside.
What's the risk to your target?
Risk of the target, quite frankly, is more on the inflationary side in our view. It's been a little bit stickier. I think that could be the biggest issue. And I think too, Tommy and I have been talking about this for years. I mean, the whole focus on Fed funds futures and all this kind of stuff. I mean, let's just stop focusing on that. Let's just look more at what's happening in the underlying parts of the stock market.
Yeah, I'm looking here. I mean, Ari, help me here. Who got buried by the Minnesota Vikings?
Here we go.
Sam Darnold. They just said, "See ya." I mean, they just didn't give him the deal.
Bye. Listen,
they didn't.
If you look at his eyes, right? Okay, look into his eyes, brother. The last
Lisa,
game.
if I ever do this to you, it's an HR violation.
Oh my God!
I'm going to be a
Jeff
JetBlue later.
Like
I'm going to be a JetBlue
meet
this
the
weekend
parents.
to see the Swaks in
Right.
Fort Myers. Anyway, look into his eyes versus the Lions, and then look into his eyes during the playoff game. He was not there, man.
Right.
He was not there.
Okay, you mentioned Ricky Bobby. Are your kids as well managed as Texas Ranger?
Listen. Last night, I think my daughter had some delicious Taco Bell, but she also informed me this morning in St. Bonifacius, Minnesota, they got 5 inches of snow. They got 10 inches of snow in Lakeville, Minnesota.
Yeah. Okay, in Duluth, they got snow as well. I noticed Duluth exports to Canada. Their second largest exports to Algeria. It's iron ore. It's like real people. I've spent some time with those people. You're giving me optimism on America, and I'm looking at Duluth, Minnesota crushed on tariffs. How can you have the two?
Well, another thing about Duluth, Minnesota, you know that Duluth, Minnesota has the largest Polish cemetery in the world outside of Poland. Did you know that?
I did not know.
So you know it now.
Learning every day.
Listen, I think that there's different things going on in terms of Duluth and Minnesota in particular, because you have the North and the South, which are dominated by mining up north and farming in the South, which obviously you heard the president's address with respect to the farmers. But in terms of the North, it's been kind of more of a mixed picture. And there is still a lot of, obviously, back and forth trade between, let's call it Duluth and Thunder Bay, Ontario, if you know your geography. But I do think that Minnesota, given the massive amounts of state GDP that is tied to Ontario in particular, this is actually more emotional with respect to Minnesota. But obviously, you've heard with respect to some of the news, who knows how long these tariffs are going to be.
That's the key thing. Your x-axis.
Here's the way I want you to think about this, Tom. Okay. This will be in your knowledge. I don't know much about fixed income, but in terms of bonds, it's all about duration and convexity, right? So let's talk about the duration of tariffs. How long? They could be gone today. I mean, that's the risk.
Gautam Mukunda of Yale was just on and said the same thing. We had from PGIM, their leading quant analyst. He said the same thing, MIT Physics. And I'm sure Ian Lingen would say the same thing. Folks, the x-axis right now, the media doesn't look at the timeline. And Professor Belsky is correct. It's all about the length. And you get to optimism like Belsky when you believe the timeline is shorter. The leader of Mexico, Sheinbaum, is out now. If tariffs continue, Mexico will reach out to Canada.
Well, we've been talking so much about the Midwest, Middle America here.
Do you want to get something in here right now?
I do.
Have you seen Talladega Nights?
Of course I have.
Thank you. Okay, you can continue.
Well,
are you going to say with all due respect, Belsky?
No, be that as it may. No, not at all. I was going to pick your brain on, obviously, when it comes to the beige book, I mean, that's never really market moving here, but I feel like it's going to be more closely watched now. Obviously, it's going to be a little bit more backward looking, but when it comes to the different districts, and particularly in the Midwest or other regions, what kind of sticks out to you, and what kind of indicators within those types of reports do you keep a close eye on?
Where we're seeing the most economic and population growth is clearly those areas that are more some more tax friendly. So the Southeast, or even Texas and Tennessee and some of those areas. So if we're going to see weakness in those areas, I think that would be a telling on that. Number one. Number two, again, macro data I've always had an issue with historically You mentioned MIT, PhD. I'm from St. Cloud State University. I mean, there's not much difference between that, quite frankly. But, it is what happened yesterday. And I think we have to remind ourselves that stocks lead earnings, which lead the economy. And, oh, by the way, stocks are leading indicators, and they've kind of told us what's happening. And so are we seeing a slowdown? You asked me earlier what the risk is. If we slow down too much, right, and we're throwing these tariffs, which, again, duration and convexity, and we still have this mixed inflation picture, that kind of puts in a more of a muddle type market scenario.
Serious question, parse stagflation versus a lesser but still buoyant nominal GDP that keeps American business going.
Yeah, I think the stagflation argument has become increasingly, let's call it consensus. I think what's happening, let's go back to the normalcy side of things. When Tom was at Rauscher Pierce and I was at a place called Dane Bosworth, we had these periods in the mid 90s where we had kind of low single digit GDP, 5%, 4 to 5% 10-year treasuries. Remember that, Tommy? Yeah. And 10% earnings growth. I think that's kind of where we're going. Shocked. And I think we just don't know what normal is because we think that normal is 0% interest rates and all these wild moves in the market.
In the modern day, you don't know it, folks, but Minnesota was a massive, and this was off of IDS and all, was a huge financial component. And a good morning to all up in the northwest of Piper Jaffray and Dane Bosworth from years ago. It was really something. And the Canadians came in and said, these are the smartest guys in the block. Let's buy them. And that's how you get RBC and BMO, Bank of Montreal, into it. We're with Brian Belsky with his optimism on the equity markets. A little red on the screen. We've given it back off ADP into the jobs report on Friday. Jess Menton to Brian Belsky.
So the past 2 years, of course, the boom in the markets, adding $18 trillion to the market cap for the S&P 500, up close to 50% for the past 2 years. So the third year in the bull market, typically you do see those gains slow down throughout history. But of course, when you have such a strong run, does this make sense where we're at in the calendar? And especially when you think about the presidential cycle, typically weaker at this point in the first quarter post-election.
100%. You typically, in especially February and March, have weaker seasonality. Because the platforms are coming out and people are reacting to what's happening and actually typically seeing things be put to work. Now, clearly in the last 42 or 43 days, we haven't seen this kind of flurry of activity that President Trump's been doing. But at the end of the day, if you kind of take two steps back, Jess, and think about what's happened the last couple of years, 2023 was really an overreaction to tech being massively oversold. Remember the first 2 or 3 weeks, you were crazy writing about these massive
the mean reversion
moves
debate,
in big technology names. And then 2024 was, oh my gosh, AI is actually real. And we are not invested there. So then now you started to see this notion. I really believe the broadening out trade is happening. I really believe it. And you've seen how value is massively outperformed. Some of that is the defensive trade into healthcare. We think that's less fundamental and more about momentum into defense. But we think ultimately true value stocks, small mid cap. I think 10 years from now, Tom, we're going to be looking back. How come we didn't buy more small mid cap?
I mean, I look at this in the heart of the matter, Brian, and we've all lived this, is a really down market's negative 35%.
Yeah.
A bear market, Dow Jones Industrial Average, is negative 18%. And a normal, healthy correction is 10%. In the Ute of America, they've never experienced it. We're down 6% blended. And it's like people are in a panic. I'm like, I don't get it.
Well, exactly. And you think about year to date, we're basically flat and we're acting like we're down 20 to 25%. And I think that comes to the reactive nature of investors, which was exacerbated during COVID. I actually think all this stuff started
I agree.
I think all of this stuff started during the financial crisis. And then obviously, that was much more near and dear to New York and our hearts in terms of the financial world, in terms of our jobs and everything. But that really kicked things off.
Sharma has this as his book, likely my book of the year. And basically, we become addicted to let's fix it so everyone's happy.
Yeah.
That's the heart of the matter.
It is. It really is.
Okay. And one final question here. The Vikings have blown up because Sam Sia. Do the Lions look good this year? I think,
the lines look good. The lines look good.
They've improved.
I was rooting for them. I really wanted to see the Lions and the Bills in the Super Bowl.
Yes, we agree on that.
But now that the Bears have their offensive coordinator, that was a huge loss. And the Bears have a real coach. Now, whether or not they have the right quarterback there, who knows? But I think the NFC North, man, is going to be really, really competitive again.
I mean, Caleb to the rescue, right?
Well, we'll see. We'll see what happens.
See.
JJ to the rescue with the Vikings. Let's go.
Brian Belsky, thank you so much.
Thank you.
BMO Capital Markets.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
And right now, Regina Mayer joins Global Head of Clients and Markets at KPMG, truly expert on the emotion of Texas oil production, for that matter, global oil production as well. Regina, the phrase I believe from the president is drill, baby, drill. Does Texas, does the Permian, do they want to drill, baby, drill?
I think absolutely. It's been a sentiment that has dominated the industry for a decade. I think drill, baby, drill emanated from the Permian. I think we have to look at what does it really take, though, to drill, baby, drill, and how quickly you can get the production running. What are the economic incentives? I will say with WTI and Brent below 70, where WTI was $80 in mid-January, that doesn't give you a great economic incentive to drill more. And then you have to think about it takes time to find, develop, produce the wells. It's not like you can turn a tap on or off, but it's a positive environment for the industry, absolutely. And the administration is taking steps that the industry welcomes.
So as you know, oilfield service providers and big energy companies used to comprise so much more of the percentage of the top companies and big equity indexes like the S&P 500, but that changed a lot post-housing crisis. And even during Trump's last term, you still didn't see energy companies in aggregate performing that well. You even had Exxon eventually kicked out of the Dow Jones Industrial Average, but has recovered from since then. So what makes this a little bit different, even with oil prices trading around lows?
In terms of the stock prices, I don't know that we'll see huge surges in those valuations. And I do think certain parts of the sector that you mentioned, oilfield services, they're just not going to become the darlings that maybe they were in the past. I think, they're competitive now. They've figured out ways to manage effectively in a very cost-constrained environment. They're coming back into being able to be profitable and seeing growth in their backlogs. But I don't know that it's a basket of investments that will necessarily outperform in amazingly different ways. I do think it's a strong sector to continue to bet in, but I don't know if it's going to be anything like the Super 7 or some of the tech stocks that we're seeing.
When it comes to the outlook for oil and fuel prices, especially when you're thinking about the tariffs on trading partners like Canada in general, who do you think has more of the upper hand here? Is it America or Canada?
Well, I think it depends on what you mean by quote unquote upper hand, but the U.S. imports 4 million barrels per day of crude from Canada. 70% of that is processed in the Midwest. And our refineries are really geared in certain parts of the country to process only that type of crude, heavy, sour, and you can't swap it out. So we definitely will see retail gas prices increase. We're already seeing wholesale gas prices increase in the U.S. Northeast, and we'll likely see retail gasoline prices increase in the Midwest as these tariffs continue. I think the rest of the country will continue to benefit from relatively lower gasoline prices, but for sure, I think we'll see upward pressure. Now, keep in mind, gas prices are even lower than they were a year ago, so we're working with a pretty low base to come up from.
Regina, thank you so much. Too short a visit. Let's do it longer next time. Regina Mayer with us with KPMG on oil.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.